Good morning, ladies and gentlemen. Should I use the mic or can I just speak normally? Or whatever works. Okay, so good morning. My name is Oliver Karius from LGT Venture Philanthropy. We are based in Zurich and we apply a venture philanthropy model to invest into fast-growing young enterprises in emerging markets that have high societal impact. It's a great pleasure to be here. We'll actually do a double act, so we will jump in and out of one presentation, so please bear with us, but I think it's a great combination of Nicolas's work and what I will do is to share with you some very concrete examples. We have three parts to our presentation. The first is an overview of impact investing, which we thought was really interesting for you to understand the current debate. You probably have heard of impact investing. It's a new buzz, if you will, and we will talk you through and to help us anchor the discussion. And then we will go into sharing some examples, and then we will actually open up for questions and answers later on. Nothing more boring to start off with a definition, but I think it is very important to have a definition, partly because this whole impact investing approach does mean different things to different people. But I think these are two definitions from Uli Grabenwater and from the GIN, which is the Global Impact Investment Network. What is really important there are three things. Impact investing is any profit-seeking investment activity that intentionally generates measurable benefits of society. And there we have the three main elements of impact investing. It is any profit-seeking investment, i.e. you're actually looking to make some revenues so that you can sustain your business. The intentionality is really important, so it has to be an inbuilt intentionality to actually achieve societal and or environmental benefit. And the third one is measurable benefits for society. So how do you actually measure the kind of social impact that you have through your activity? And those I ask you to remember those three things because they're the most important that currently frame the debate. Where are we along this spectrum? So you probably have heard well, it's from left to right. On the left are grants, on the right is traditional investing into mainstream companies, and then you have everything in the middle there where you can actually generate impact. On the left, the primary motivation is to generate societal value. On the right is just to make money, if you will. But just for you to have that spectrum on the line, we will actually go into certain elements of that spectrum. If we look at the spectrum, then we ask ourselves, where does the capital actually come from? So let's look at the different sources of capital. You have on the left early stage investors, starting with ultra high net worth individuals who are very interested to invest into fast growing young enterprises. We then have the development institutions, foundations, right across to public pension funds, the late stage investors. And if we have this spectrum in front of us, we see a number of very interesting characteristics of these investors. Something to do about risk. On the left, the kind of risk appetite is much higher versus then if you're a late stage institutional investor on the right. The kind of returns that you perhaps want to generate or the kind of societal impact that you want to generate also varies across the spectrum. And what's interesting in our work that we see every day is that how can we get more capital into this space to actually achieve societal impact? And we can do that by tailoring the offering to each of these different investors. So you have the spectrum now from from charities to companies, and here's the spectrum from early stage investor right across to institutional investor. And impact investing applies to all of this, right? So to the whole spectrum there of investments.
Just to show you roughly how venture philanthropy sort of comes into the picture. You have a mix of the traditional approaches, the venture capital, private equity, but at the same time, on the other side, you have the philanthropists investing into different societal and social models. If we just focus on the venture capital first, as a traditional venture capital investor, you have thousands of projects coming onto your desks. They all have super elevated returns. There's a huge competition between all those projects. When you look at them, I mean, when you are a traditional investor, you're sitting on the bunch of money on yourself, and you're looking for different projects that you want to invest into, and then all of them are just trying to compete with you, which one has higher returns, and that's the only element that you actually see that differentiates these models. They have very high risk premiums have to be paid. because of the competition, each of these projects will have basically have to cover that risk of that exposure, whether it be China, whether it be Africa, anywhere else. Because of the high risk level, then you get into the very low success rate. So let's say that you are an investor and you're presented with 20 different projects. You choose 2 of them, and then you say you choose 2 of them because of the elevated returns that I mentioned before. But what it comes down to, only 50% of that gets actually created, but in reality, it's something like 15 to 20% of the venture capital portfolios that actually see the light. That does not help you with diversification of the portfolio in any shape or form. Now, on the philanthropy aspect, you make very high social impact, of course, because all your money goes into one project. You focus on that project. There's nothing that takes you off that subject. But then there's no return. Can you afford it? Probably not. Low efficiencies in the ventures that you've been created. Let's assume that there's a social project, there is a school in Africa. As long as you're putting money into it, it keeps running. What happens when you stop putting money in? Very often there's no continuation. Very often, not saying always, but for philanthropies also, there is no investment recuperation. So as you put the money in, you get a tag on the door that this is something you invested into, but practically speaking, that's all you're getting out of it. And your money, once been put into the project, is been used, and it's gone, and it's finished. You cannot really recuperate that cash and put it into anything else afterwards. Now, when you do have the opportunity to actually get at least the initial capital out, you can actually do 2, 3, 4 projects at the same time with the same amount of money. Now, nevertheless, let's look at the total market that just in philanthropy, you have over $800 billion invested every year, out of which $310 billion comes from the US. Now, how much comes from Europe, everywhere else, of course the rest, but there's so much more potential to be built on. Now, just following from that thought, you have the spectrum of venture philanthropy. You have the charitable foundation, where you have negative financial return, but quite high social environmental high social environmental impact. At the same time, on the other side, you have venture capital and with huge positive financial return, but very often quite low societal impact. Just quickly where it came from, what I mentioned before. As you've seen, as a hybrid model, it comes from both venture capital, private equity spectrum. It's traditional philanthropists who've realized that the shortcomings of sustainability of their projects, so they can invest only once. They don't know what the market is right now. In 2008, 2009, they very often lost quite a lot of capital in their traditional investment portfolios, but nonetheless realized that little returns making large social impact are more sustainable in their investment portfolio than those that do not make any impact. And they identified that a lot of companies focusing on sustainability realized new efficiencies in their processes. So it could be one even of or more traditional consultancies do look at it these days and saying, focus on sustainability, work on achieving an impact, and you're going to profit down the line at the bottom of the equation. And it's definitely an interesting opportunity to diversify their portfolios.
So what is venture philanthropy? What are the kind of criteria that defines venture philanthropy? Well, as Nicolas said, you take elements from the venture capital approach, which means that you're actually supporting organizations. This is not about project finance, this is about organizations. And you do that because you want to have it achieve a high social impact, and that's where the philanthropy aspect comes from. You also work in areas where a normal investor would not go into because it's deemed too risky or it's too emerging. Now, there are a couple of criteria from venture philanthropy which I just want to highlight. This is taken from the European Venture Philanthropy Association. Characteristics: we focus on few organizations. We don't take a spray and pray approach, but we carefully pick a number of small organizations. In our case, they should be young, rapidly growing, so we actually come in when they grow in that early growth phase. in order to support them properly, we need to apply a really hands-on due diligence to really understand the business model, the team, where do they want to grow, etc. That helps us to identify what kind of funding they need, and it helps us also to understand what the kind of growth challenges are that the organization has as they grow. Sometimes you're probably aware that if you have a young organization, if somebody would give you more money, you go like, well, that's fine, but I need talent. I need someone to help me with my processes, set up the systems, etc. So we apply intense local due diligence. We then, out of that comes the tailored financing. So we can do grants, we can do debt and equity, depending on what the organization needs. We combine that with management know-how and support. So we work actually quite hands-on with our organizations. We take a long-term approach. We know this is not going to be a quick fix, one-year type financing, but this is actually about achieving impact, and you achieve impact if the organization grows, and that growth takes time. And then you have all the wonderful things that happen with fast-growing organizations. It's never linear. You have to apply a lot of support. You have to apply a lot of continuous controlling, and that then also helps to optimize their environmental and social returns. So these are criteria of venture philanthropy. What does this look like from a structural point of view? So at the top there, you have the investor, as Nicolas said, who wants to achieve societal impact. The investor then invests or supports a venture philanthropy organization. That organization applies 3 different types of capital: financial capital, that's the financing I spoke about; the intellectual capital, that's the business support; and social capital, that's the kind of access to networks, to investee organizations wherever they might be. And these are organizations. I'm not talking about projects, as I mentioned. These organizations do their projects or whatever they do, that achieves the impact, and that's one of the main motivations which go back to the investor. And the important thing is really we have a game in our office where if everybody of my colleagues says, let's support this project, they have to put a little franc into the coffee tin. Because if you think about project, it has a start point and it has an end point. But as soon as you use the word organization or company or whatever it might be, you actually think about structures, you think about the support, you think about the growth of the organization. So, Nicolas.
Yeah, shift a bit. Going back to really defining the market, the size of the market globally is predicted to grow up to $1 trillion over the next 10 years. Globally. This is really, really huge. When you look at just one spectrum of it, if you focus on supporting the underprivileged society that earning less than $3,000 per year, the potential to the investor over the next 10 years is to produce profits of $183 to $667 billion out of that, just for the investors. It's important that if you invest $1 trillion to help the poor people, you as investors or people who you are associated with as investors can still profit out of it. It doesn't mean that this money is misused. This money, once it creates that profit, can be reinvested into doing second, third, fourth project, as I mentioned before. And it makes it sustainable in the long run. When you look at just the traditional supply and demand curve, on the x-axis you have grants and investment capital. On the y-axis you have social mix and commercial sort of types of organizations. The traditional that you know so far, which was the traditional philanthropy investments, all sorts of other investment that is the grants and the societal, which is only this little box here. Now, when you look at the commercial ones, which are normal investments in here, and then subsidies in this little corner up on the left-hand side. This is also a small size. Now compare it to this blue sector, which is a mix of blended opportunities between investment capital, grants initially, and then huge societal impact. The investment actually does, you don't hear me? Okay. The investment made in VP since the beginning responds to around 1 billion, but there is another 1 billion opportunity to come. In terms of a bit of statistics, venture philanthropy spent in 2010 sort of divided into different sectors in Huras, you have 27% in projects that represent health investments, 21 in education, 9% in environment, and so forth in other sort of areas. Now, at the same time, in the geographic spend, you have 30% so far in domestic market, but at the same time, you have 18% in Africa, 10% in Asia, anywhere else. The European is still very, very small. So we are definitely focusing on that and making sure that the European spending also gets sort of put down on the picture, as it is the easiest market to start with. As you've seen, then the definition of venture philanthropy is a mix between traditional philanthropy and venture capital. So it is really a win-win situation for everybody. So it has a high financial return, but at the same time, it has a very high social impact. Just to give you a few examples of what roles can venture philanthropy actually help in the society. It provides access to affordable capital. It brings business knowledge, expertise, technical assistance. It engages marginalized groups, so women and youth in the society, in venture, in creating new enterprises. When we look now at the 2011 World Economic Reform Forum risk sort of chart. It's okay.
You need some power.
Sounds like it. We have again two axes. So we have the perceived impact in dollars on the global society and the likelihood of this happening. So when we look, is there the pointer thing here? Don't know what it is. Anyway, when we look at the top right-hand corner, which is the sort of most important and the very likely coming risks. Oh, where is it? There we go. You see that there is fiscal crisis, geographical conflict, climate change, extreme energy price volatility, economic disparity, water security, etc. When we maximize this, we see that all those stars showing you how venture philanthropy or impact investment can actually tackle all those issues that are the most highly, they present the highest risks to the society these days. So we have climate change, energy volatility, price volatility, economic disparity, global governance failures, water security, chronic diseases, organized crime, even, or food security. It all can really be tackled by impact investment solutions. I'll pass back to...
So what does this mean in practice? Essentially, we're confronted with a picture where around 4 billion people live on less than $2 a day, and you get these incredible economic disparities like they're depicted here. Now, the situation, while it's very stark, also requires some innovative solutions, some new approaches to actually funding basic services, for instance, for the less advantaged to improve the quality of life. And there are some tremendous opportunities to be found on the left-hand side if you're just able to pick the right entrepreneur with the right organization, because that market is huge and there is a huge demand for the basic services. We at LGT Venture Philanthropy, we are a charitable foundation. We were set up 5 years ago, and our mission is to improve the sustainable quality of life of less advantaged people. We are primarily funded by the Prince of Liechtenstein, Prince Max, and we do three things. We want to inspire people so that they get excited about some fantastic new opportunities out there, particularly in emerging markets on which we primarily focus, that show what innovative solutions actually exist. We advise our clients in how best they should do their philanthropy or their impact investing. And then we have invested ourselves over the last 5 years into a portfolio of over 20 organizations, reaching over 6 million people. So it is for us the kind of circle of inspiring people, then advising them what to do, and then implementing. And you can start that circle wherever you want to. We started with the implementation side, i.e. investing directly into portfolio organizations. We have a House of Philanthropies of Solutions in Zurich, where we showcase the solutions or the organization that we support in each of the themes. and then we advise the clients, both for the bank, but also for independent, for external clients. If you look at the market, these are our 7 themes, so let me start with the first 3 that we have. We have education, health, and water. And the kind of base of the pyramid, or the kind of market potential that people estimate, that there's an investment opportunity of up to 10 billion in education, up to 2 billion in health, and 13 billion in water. These are rough estimates, of course, everybody knows that. But what I want to show here, that A, the market is there, it's big. And second of all, there are some very interesting organizations that are providing innovative solutions that either finance themselves or generate or require some grant funding to get going, but essentially having very innovative new models that try to tackle some of these problems that we are faced with. The other 4, resource management, agriculture, renewable energy, and infrastructure for social investments. Again, here, same message, big market, big opportunity. Particularly if you take an example like mobile payments in Africa, you have 600 million mobile phone users in Africa. Africa population is just over 1 billion, and 7 years ago an innovative payment system was invented using mobile phones. Nobody would have thought that anybody with a mobile phone would actually use that kind of payment system. Now M-Pesa in Kenya has over 7 million clients, and they're doing extremely well. So what is interesting from our perspective and for our clients is that through investing into these organizations in emerging markets, we're able to identify new business models that we can then take into other markets, particularly also if you look at Europe, what the kind of challenges that we're facing now. We've built a team of over 20 colleagues of ours. The majority is actually based in the regions in which we work. So we have Latin America, Africa, India, Southeast Asia, and China. And we are embedded in a broad ecosystem, if you will, of different organizations like the one that Nicolas has set up, or the EVPA. You have angel investment networks like Tonic. You have different investors and foundations like the DOB Foundation, the Asia Venture Philanthropy Association. And what's very interesting is that 5 years ago we were nowhere. We had a handful, particularly also in the regions in which we work. So in Latin America, deal flow, local investors, local intermediaries and organizations just did not exist. So what is really interesting to see is that you see an emergent, not just an emergent asset class or a way of thinking about impact, but also that the local markets are really generating their own capital, their deal flow, etc. So it's less about the kind of north-south distribution and redirecting of capital, but in each of the markets we see a lot of activity on the ground, a lot of deal flow. So I mentioned the team. We've invested up to 8.6 million so far. Actually, yesterday we had another board meeting. We will actually go up to around 18 million. We have a whole range of new deals in the pipeline. Through our portfolio organization, we're reaching 6.1 million lives. This was at December. Sorry, and the portfolio growth is as we had planned. We took quite some time to get started, but now it's really ramping up quite nicely in each of the regions. And that's spread around, the distributions around a third is in grants, debt, and equity. What are some of the challenges that we see, or that Andy sees, which is the Aspen Network for Development Entrepreneurs? They say in this market, you have to get this kind of circle going, right? Of if you want to raise capital, there are challenges there, but once you raise the capital, you want to find the businesses that you can invest in, then you do the deal, then you achieve your impact, and then you exit. Now, what we've seen with this emerging market is that this chain is broken, or it's not broken, but there are certain challenges along each of these elements. And what you saw with those other membership organizations, each one of them is trying to tackle a different part of this system. And once we get the system going, once you get good exits, then people say, hey, look, there are some interesting deals over that will attract more capital. Then more deals will come because they will say, an entrepreneur says, here's an investor I want to work with. Then you start doing the deals and you achieve your impact, and that gets the circle going. To make it concrete, I'd like to take it to the Philippines, to one of our portfolio organizations called Rags to Riches. This is an organization that we've supported since 2009. The issue there is that on the top left-hand corner you have a lot of landfills, and you have a lot of material waste, which is just being thrown away. And Rags to Riches basically works with, they were initially called rag pickers. These are women who went through these dumps and picked up the fabrics that they found. They wove it into so beautiful rugs, and what if they've developed a whole range of beautiful accessories, bags, etc., which are now actually sold in high-end stores in the Philippines. And at the bottom right-hand corner, you have empowered women, because finally they're able to get proper employment. They don't have to do this on their own anymore. They start working in cooperatives. They achieve an income, they're insured, etc. So it is helping women. In this case, it's helping women to achieve livelihood and to produce a product out of a waste that you would normally throw away. And Rags to Riches does that in a for-profit way, which means from the sale of the handbags and the rugs, etc., they're able to employ more women, and they're able to then fabricate more products. The way we look at impact, this is on Rags to Riches, just to give you some numbers. That when we started, there were 9 communities, now they're in 23 communities, and the average income per woman or artisan has increased from $151 to around 600, or what is it now, 370 this year. So it is really helping Rags to Riches to grow as an organization. And the key value add that we've done, because this organization has grown so fast, is to provide them with the right funding in 2009. We then did a detailed due diligence and then had to work with providing more, increasing their supply of scrap material. They were running out of scrap material. So we talked to Tommy Hilfinger, who was sitting a lot of scrap material, saying, in Asia, can you please supply Rags to Riches with that supply material? Then we got into the kind of quality issue that the rags that they were trying to sell weren't quite up to scratch, because the women who had been trained weren't trained on a regular basis. So Rags to Riches had to start improving their training program to also be able to develop products which you can sell at a high margin and are sort of the high-end products. And finally, we were able to attract some additional funding from a third party, from a foundation in Germany, who said, this is a great little investment, I want to put in 200,000. So what I want to show here, that this is an evolution. We did not just sign the check in 2009 and walked away and expect an annual report from them every day, but this is very much around understanding the business, working with them on a sometimes day-to-day basis, actually, to work through some key strategic issues, provide the hand-holding, provide the support, attract additional funding, and we are now actually looking at Series A for Rags to Riches, which is the next kind of funding round, because they're now able to absorb that kind of capital. That was the Philippines. Just to share with you 2 more examples. This is a school organization in Kenya. It's called Bridge International Academies. They operate private schools in the slums of Kenya. These schools offer affordable education for around $5 per child per month. This is a for-profit model. And what they do is they build up these very low-cost schools, if you will, provide standardized curriculum, reduce costs because they keep the whole system very lean, and they now have around 2,700 children. And they're setting up the schools in areas where there's no government school, where there's no private school, so they actually go into the areas which are underserved, and they have a potential market of around 6 million school children who actually want to go to school but cannot go to school because the schools don't exist, and the parents feel very passionately that paying $4 per month or $5, yes, it's a payment, but they're able to afford it because they see the value add of Bridge International Academy. They started with 2 schools. We did an equity investment into them with 2 schools to see whether the model works, and they now scale this up to around 50 schools, and they're going to go to 300 schools in the next 2 or 3 years. And finally, let's go to Latin America. This is an organization called Meds and Foods for Kids in Haiti. As you probably know, so severe and moderately malnourished children, there's a very easy way to treat that. In this case, it's with a product called Medica Mamba, which is a peanut paste, which has all the essential proteins and vitamins and minerals and sugar, which you can store at room temperature, and you can very quickly treat malnourished children. This is a small organization that was set up in Haiti. They were doing this out of their kitchen and back office, basically, and they came to us and said, look, the market is so big, can we please, we want to set up a professional production facility which gets certified under UNICEF so that we can actually make that product and sell that product not only into Haiti, but all the other surrounding islands. So we came in, worked with them, did the strategic plan, organized the funding, etc., and we had the Global Alliance for Improved Nutrition came in as well as a co-funder, doing a co-investment with us, and we just saw the pictures actually of the factory, and that's up and running, which is exciting. Now, what we like there is that it was extremely well run, so it was really good management. They had the vision where they wanted to go, but they just did not have, they could not find any local capital. No local bank would give them money, and no local private equity investor would give them money because they would look at this and say, look, the returns are so low, it's not commensurate with the kind of risk that we're taking, we're not interested. So you find a lot of those organizations that are stuck somewhere in between. Grants would be the wrong kind of funding for this organization because that would lead to them not taking care of the funding. And we want to make sure that this is a self-sustaining business. So that once we exit or we get our capital back at a very low interest rate, we can say, look, they're now supplying X thousand of children in Haiti and the surrounding area, and it's a well-functioning organization that meets the social need. Finally, before we go into the Q&A and questions, I just wanted to highlight what we offer our clients. We offer a number of opportunities or options if the client wants to donate. They can do that through us as our foundation. They can come to us and say, look, Oliver, I'm really interested in Africa, but I'm not interested in Haiti, so can you please set up a managed account for me? We do that for our clients. And we set up own foundations for clients. That's on the donation side. If somebody wants to invest and at least use debt and equity as a means to support business models that generate revenue, we are setting up funds. We are currently setting up our own fund, and we're doing that for a client in the UK. For a UK vehicle, we have a number of managed accounts as well, and we can set up funds for clients who say, this is the Ernst Müller fund that invests into women into Southeast Asia. They don't want to do the heavy lifting. We can do the heavy lifting for the clients. They can celebrate the impact and be involved in the whole due diligence process, etc. So that's us in a nutshell. I hope that sort of brought to life a little bit the kind of venture philanthropy approach and the types of organizations that you can support. And with that, we'd like to open up to Q&A.